Brad Williams, Frugal Finance. We're going to talk about interest rate options, and this is a very, very complex arena. I'm not going to get way involved in terms of all of the complexity of Black-Scholes. I'm not going to get into the binomial model, even though I mentioned it a little bit. I'm going to give you an overview. There's 15 sessions in the option pricing model. I'm going to summarize this information. If you want more details, let me know. If you want references, let me know. With that being said, I'm just going to go through and give you an overview of Black-Scholes, and then we're going to step up. And this is very, very, very heavy in terms of equations. That's the structure of Black-Scholes, and that's why it is as popular as it is. You guys are a couple geniuses, and subsequently they passed this on, and since then, there are a lot of offshoots of the Black-Scholes option pricing model, and I won't get into them all, but I'll show you a few illustrations. That being said, Brad Williams, Frugal Finance, if I didn't say that earlier, and if you don't know by now, this is going to be about the Black-Scholes option pricing model. Fisher Black and Myron Scholes developed their option pricing model under the assumption that asset prices adjust to prevent arbitrage, that stock prices must change continuously, and that stock returns follow a log normal distribution. In addition, their design holds for European call options on stocks with no dividends. Further, they assume that the interest rate and volatility of the stock include stochastic calculus. We're not going down that road. They did all the hard work. I'm going to explain what they've done in general terms, very general terms. If you're weak in terms of statistics, you need to bust out a statistics book. If you don't know what standard deviation is, if you don't know what variance is, if you don't know what covariance is, you're going to need to open up a stats book. Just review that information. In this section, we present their model and illustrate the basic intuition that underlies it. We're not going to delve in too deep here. We show that the form of the Black-Scholes model parallels the bounds on option pricing that we've already observed. In fact, the form of Black-Scholes is very close to the binomial model. The Black-Scholes call option pricing model, the following expressions gives the Black-Scholes option pricing model for a call option, which is the call price is equal to strike times normal distribution DISA 1 times X EXP. This is all the discount normally distributed of DISA 2, where N is the cumulative normal distribution function along with equation 1314, which is DISA 1 is equal log normal. This is pretty heavy stuff. We'll break it down as we move forward. So you have DISA 1, DISA 2. These are the two drivers. This is going to determine a call price. This model has a general form that we have long considered. The value of a call must equal or exceed the stock price minus the present value of the exercise price. So C greater than equal to strike minus X EXP. This would be the present value calculation. To adapt this formula to account for risk, as in Black-Scholes model, we multiply the stock price and the exercise price by some factor to account for risk, giving the general formula call price greater than strike times risk factor minus EXP times risk factor 1. Equation 3.2, look at this thing. By all means, I'm not going down this road trying to explain every variable here. You want to do that? Feel free to do so. It'll take up way too much time. I just want to present this information to you. You can research this more if you want to. With that, I'm going to close this introduction and then present to you 14 other Black-Scholes related topics. Brad Williams, Frugal Finance. Thanks for watching.